You've tuned into another deep dive, and we're jumping straight in today. You shared some really compelling material with us, and we're going to be dissecting market research pitfalls when your insights lead to false conclusions by Vinny Akbali. Our mission really is to get under the skin of this topic. We want to pull out the key insights about what happens when market research, well, goes wrong, and, crucially, how businesses can steer clear of those mistakes.
Exactly. And we need to tackle that core question. What are the actual dangers, the real risks of basing big decisions on flawed research? And, what practical steps can companies actually take to make sure they're on solid ground? We know our listeners come from all sorts of backgrounds, maybe prepping for a meeting, maybe just curious. So we're aiming for insights that are valuable, but also, easy to digest, not overwhelming.
Okay, let's start unpacking this then. The piece kicks off by looking at the fallout, the consequences, when market research data leads you down the wrong path. And the first big one is pretty direct. Financial loss. We're not just talking small change here, are we?
Oh, not at all. What's really striking is how the flawed data connects directly to a much bigger impact than just, say, one failed project. Think about a tech company. They misread the market demand for a new feature, maybe based on some shaky survey results. The immediate hit, millions spent developing and marketing something nobody really wants. That's bad enough.
Yeah.
But think beyond that initial write-down. There's the opportunity cost. It's not just the millions gone, but what could have been done with those resources if they were pointed in the right direction? Maybe a more successful product, maybe expansion into a market that was viable, or even just strengthening other parts of the business. That unseen cost, it can be way bigger in the long run.
That really reframes it, doesn't it? It's not just the money spent, it's the potential that was lost. And the article also mentions how these kinds of missteps can eat away at overall profitability, maybe even shake investor confidence.
Precisely, yeah. I mean, if investors see a company making major blunders because of bad info, their trust definitely erodes. It makes them question the leadership's judgment, right? Their ability to navigate the market effectively. And that can have serious long-term effects on getting funding and just sustaining growth.
Okay, shifting gears a little bit.
Yeah.
The piece also digs into something maybe harder to put a number on, but just is damaging, reputational damage.
Yeah.
This feels, well, especially critical today with how connected everything is.
It absolutely is. Think about launching a marketing campaign that's built on, say, a flawed understanding of who you're trying to reach. If that campaign just misses the mark, or worse, actually alienates the very people you wanted to connect with, well, the backlash can be incredibly fast and intense. Social media just pours fuel on that fire, doesn't it? Negative sentiment spreads like wildfire.
And as the article points out, fixing that kind of damage isn't quick. It can take a lot of time, a lot of resources to rebuild that trust and loyalty.
A huge amount. And it's not just about, a few angry tweets. In today's world, a big misstep based on poor market understanding can genuinely damage your brand equity, that sort of intangible value people associate with your name. That's a long-term asset you're putting at risk. And repairing it needs serious investment in PR, customer retention, and there's no guarantee you'll fully recover.
The third major consequence the article highlights is how bad data can really mess up your long-term strategic planning, your whole direction, really.
Yeah, if you connect this to the bigger picture, imagine making those huge decisions. How big is our market, really? Who are our actual competitors? What do our customers truly need moving forward? Imagine basing all of that on flawed information. You're essentially charting a course for your company that's just fundamentally wrong.
And the article talks about a compounding effect here, which sounds particularly dangerous for staying successful over time.
It really is. These initial mistakes, they don't just sit there in isolation. They can cascade. They lead to a whole chain of misaligned goals, missed opportunities later on, and in fast-moving industries. That's a massive threat. It really hinders a company's ability to adapt. It could even lead to, well, becoming obsolete as competitors who do have accurate data just race ahead.
So we've looked at the money drain, the damaged reputation, the strategic wrong turns. Now, the article gets into the why. What are the root causes? Why does this bad data actually end up influencing our decisions?
That's a crucial question. The article points to several key things. One is simply relying on outdated information, or maybe using poorly designed surveys, or not getting enough responses, insufficient sample sizes. There's often this tension, isn't there, between wanting info quickly and cheaply versus needing it to be accurate and reliable.
That makes total sense. We've all seen those quick online polls, right? They give you a snapshot, maybe, but it's hardly a deep understanding. The article specifically mentions social media polls as, convenient, but just lacking the rigor you need for big strategic calls.
Exactly. Pushing for speed and low cost in data collection, it's tempting, but it very often means you compromise on quality. It's sort of like building a house with cheap materials. Might look okay at first, but it won't hold up under pressure.
Another reason mentioned for bad data leading to bad decisions. It isn't always that the data itself is just plain wrong, but how it gets interpreted. That's an interesting angle.
Yeah, what's fascinating here is that even if you have good quality data, if the analysis is weak, maybe because you lack the right expertise or the right tools, you can still end up drawing the wrong conclusions. It's like having all the perfect ingredients for a fancy meal, but messing up the cooking process.
Right. And then there's that very human element,
Yeah.
confirmation bias. We tend to look for proof of what we already think, don't we?
Oh, absolutely. That tendency to interpret data in a way that just confirms what we already believe, it's incredibly powerful. It can blind you to evidence that contradicts your view, and it ends up reinforcing flawed strategies, maybe without you even realizing it. You might unintentionally focus on data points supporting your hunch while ignoring others that suggest you're maybe heading down the wrong path. Imagine you're convinced your new eco product will be a smash hit with millennials. You might then latch on to positive comments from a small environmental forum, right? While maybe ignoring broader data showing that actually price is a much bigger deal for that group.
Yeah. Finally, the article mentions the increasing reliance on third-party data providers. Now, they can be useful, but there are definite risks there too.
Yeah, connecting this back, it's just vital to remember that not all data is the same quality, and not every data set fits every business need. If you don't rigorously check out these third-party sources, make sure their data really aligns with your specific situation and market.
Yeah.
Well, you're taking a big gamble. And this is especially true in dynamic industries where data gets old really, really fast.
Okay, so we understand the dangers and some of the reasons this happens. Now, the important bit. What can businesses actually do to protect themselves? The article lays out some key strategies.
Absolutely. The first, most fundamental step. Prioritize data quality right from the start. This means being really intentional about where you get your data. Choose reliable, reputable sources, think government databases, established industry reports, thoroughly vetted third-party providers. It's about building your insights on a strong foundation.
And when you're collecting your own data, especially through surveys, the way you design those surveys is critical, isn't it?
Oh, it's absolutely crucial. Investing in good survey design helps minimize biases, ensures your questions are clear, not confusing, and that you're actually reaching a group that represents your target audience. Even if you're using cheaper tools, the underlying method has to be sound. The article even suggests it can be worth the money to bring in professional survey designers or market research experts just to make sure you get that vital stage right. Think about how you phrase questions, for example. A leading question like, "Don't you agree this product is fantastic?" Okay, well, that's going to skew your results immediately. You need neutral, open questions to get real feedback.
Okay, so you've got the data. The article then stresses you can't just take it at face value. You need to actively validate it, cross-reference it.
Yes. This is where critical thinking, maybe even a bit of healthy skepticism comes in. Checking your findings against other independent sources helps confirm consistency, accuracy. And analytical tools, things like Tableau or Power BI, they can be incredibly helpful here. They let you visualize data, spot outliers, see inconsistencies that might flag up problems. And like the article says, don't forget the value of comparing your numbers with, qualitative stuff, real-world observations, other existing research.
Finally, and this feels like a really key long-term strategy, it's about building a culture of data literacy across the whole organization.
Exactly. If you equip your employees with the skills to actually understand, analyze, and interpret data properly, that's a powerful defense against making bad calls based on shaky info. This could mean things like targeted training, investing in easy-to-use analytics software, and really encouraging a mindset where people feel okay questioning assumptions, thinking critically about the data they see.
The article then backs this up with some real-world examples, companies that really felt the impact of bad data. The first one that jumps out is Target's big move into Canada back in 2013. That was a pretty major misstep, right?
Oh, it was a huge setback. Truly massive. The article highlights how Target massively overestimated demand up there, and it was based on market data that turned out to be incomplete and, frankly, poorly analyzed. The result was just a cascade of problems, supply chain chaos, warehouses stuffed with unsold goods. And ultimately, they had to close all their Canadian stores. That cost them something like USD $2 billion. It's just such a stark reminder of how vital it is to get that initial market assessment fundamentally right.
Wow. And then there's the example of Netflix, their early recommendation system.
Yeah.
It's easy to forget they had some teething problems with that.
Yeah. Yeah, what's interesting there is even a company like Netflix, which you think of as totally data-driven, they ran into issues with data quality and interpretation early on. Their first algorithms sometimes suggested films that were just, well, irrelevant or unpopular, which obviously wasn't great for the user experience. So, recognizing that, they invested heavily. They refined their algorithms, made sure they were built on accurate, representative user preference data. And the result, much better customer satisfaction, and it definitely helped strengthen their market leadership.
These examples really drive home the stakes involved. The article then goes into the longer-term effects of consistently relying on bad data. And it paints a pretty worrying picture for long-term business health.
Yeah, the erosion of trust within the company itself is a big one. If people repeatedly see decisions based on flawed insights leading to bad outcomes, they naturally get skeptical about data in general. This can really stifle innovation. Teams become hesitant to take risks or try new things, and it can also get in the way of effective collaboration between different departments.
And the article mentions a kind of domino effect, where one bad decision early on triggers a whole chain reaction of negative stuff through the business.
Precisely. Like, say you misjudge market demand. That can lead to piling up excess inventory, which then might strain your relationships with suppliers and ultimately hit your cash flow hard. These problems are often interconnected, and they can compound over time, making it harder and harder for the business to get back on track and stay competitive.
Maybe one of the most concerning long-term impacts, though, is just being unable to adapt effectively when market conditions change rapidly, especially if you're working with outdated or just plain wrong information.
Right. In today's world, business moves so fast. Agility, responsiveness, they're absolutely key. So companies making strategic calls based on flawed data, they're basically flying blind, operating without a clear view of their surroundings. They're highly likely to miss emerging trends, fail to spot new competitors, misunderstand shifts in what customers want, and that leaves them really vulnerable to disruption and potentially facing a slow, gradual loss of market share and relevance.
To really hammer home the scale of this issue, the article throws in a pretty startling fast fact.
Yes, it cites an IBM estimate that bad data costs the U.S. economy over, wait for it, USD 3.1 trillion annually. That figure is just mind-boggling. It
Okay.
really underscores the massive financial and operational risks tied to poor quality data, not just for individual companies, but for the whole economy.
Wow, 3.1 trillion. That really puts the potential impact into sharp focus. So to sort of wrap up our deep dive into Vinay Bali's insights here, we've explored the very real financial hits, the reputational risks, the strategic pitfalls that come from relying on flawed market research. We've also looked at some common reasons why this happens, and importantly, the practical, proactive steps businesses can take. Things like prioritizing data quality, investing in proper analysis, and building a data-savvy culture.
Exactly. It's not just about grabbing data, it's the whole process, isn't it? Getting the right data from reliable places, using effective ways to analyze it, and creating an environment where decisions driven by data are actually based on good information and critical thought.
So, reflecting on all this and thinking about those examples like Target and Netflix, here's a final thought for you, our listeners. Considering the specifics of your own field, your own industry, what potentially overlooked data points might be absolutely critical for you to avoid similar pitfalls in your work? It might be worth taking some time to really look hard at your current data sources, maybe explore some new ones, just to ensure you're building your strategies on the strongest possible foundation. Thanks for joining us for this deep dive.